This presentation will share the findings of our financial analysis of Lowe's and Home Depot. We will discuss the ownership of the organization, as well as the cost of equity and debt financing, as well as the WACC, the weighted average cost of capital for each company. We will also share the results of our analysis of the possible changes to the overall capital structure and its impact to the companies. Lastly, we will give our analysis of the stock in relation to the current market value.
Who are the owners? The owners of Home Depot and Lowe's are the common stock investors. Both Lowe's and Home Depot have over 1 billion shares of stock outstanding. Lowe's has 79% and Home Depot has 76% of their stock owned by institutional investors. The institutional investors are highlighted by the Vanguard Group and State Street Corporation. Both are in the top 3 overall amongst institutional owners for Lowe's and Home Depot. Why do shareholders care about the cost of capital? If the cost of capital is not balanced proportionally with debt, equity, and tax, a firm cannot realize their primary goal, and that is to maximize the fundamental or intrinsic value of the firm's stock. 4 factors influence the optimal cost of capital and debt. Tax rate. The higher a firm's tax rate, the higher the optimal debt ratio. Interest coverage. Interest coverage is a good indicator of whether a company has the capacity to take on more debt. Default spreads. When a firm increases its debt ratio through borrowing of more money, it has an adverse effect on the company's bond rating. Capital projects. Both Home Depot and Lowe's are big box, brick and mortar operations and require large land and building in order to serve their customers. Therefore, both firms need to keep their debt ratios low. What is our cost of debt financing? When looking at a company's debt structure, we want to take under consideration their overall weighted average cost of capital. The cost of debt can be measured on a before-tax or after-tax basis, but the after-tax rate is most prominent throughout the finance industry. Cost of debt on a pre-tax basis is the sum of the firm's risk-free rate and its corresponding default rate. As stated earlier, both Home Depot and Lowe's has a credit rating of A, which correlates to a default spread of 1. Therefore, the following calculations reflect the cost of debt financing for both companies. What is our cost of equity financing? Cost of equity financing is the cost of issuing common stock. It can be measured using 3 different models. The capital asset model, known as CAPN, discounted cash flow model, and 1 bond yield plus risk premium model. Our analysis will use the CAP-M approach. Under this approach, the risk-free rate is added to the firm's beta, which is first multiplied to the difference of the market risk minus the risk-free rate. The following formula for CAP-N calculates our cost of equity.
What is the overall cost of capital? The overall cost of capital depends on the method used to raise capital for the company. Companies can be financed through debt or equities or both. When a company uses both debt and equity to finance a business, the overall cost of capital is derived from the weighted average cost of capital, or the WACC. This is the minimum value that a project must generate for the company to break even on the project. As we can see below, the WACC for Home Depot is 2.99%, and the WACC for Lowe's is 3.16%. Therefore, in order for a project to be viable, they must make a minimum of 2.99% for Home Depot or 3.16% for Lowe's to be a viable project. Could we lower this by changing our capital structure? The results from our analysis show that we can make positive changes to our capital structure by increasing debt for both companies. Currently, Lowe's has a debt-to-equity ratio of 20.17%. Our analysis shows that Lowe's could increase their debt-to-equity to an optimal level of 30%. This increase will improve the WACC by 4 basis points, from the current 6.61% to 6.57%. Home Depot can also increase their debt to an optimal level of 20%, from a current 13.7%, an overall net change of 6.29%. This change will have a positive impact on WACC of only 1 basis point, from the current 5.69% to 5.68%. How would a financial restructuring affect the value of our company? Our analysis shows that by increasing the overall debt to equity for both Lowe's and Home Depot, it'll have a positive impact on the firm's value, or the perpetual growth. For Lowe's, the increase in debt will increase the firm value from $67.9 billion to $68.5 billion, an overall change of a net $637 million increase in firm value. For Home Depot, the increase of debt to equity would take the company from an overall value of $134.8 billion to $135.2 billion, an overall increase of $442 million. Would more debt create unnecessary risk? Although the increase in debt to equity will have a positive impact to the overall firm value of both companies, it may not be enough to justify the increase in risk. The overall increase in value for both firms is less than 1%. The added debt may cause the companies to be downgraded, thereby increasing the cost of debt to finance future projects. Careful consideration should be given to the overall impact of future costs of debt financing. What does the competition do? In assessing the overall competitor landscape for Home Depot and Lowe's, we have the Menard Inc. Group and True Value Company that are both privately held. Privately held companies are more difficult to assess since most of their information is not readily available. We do, however, find that the revenue for both Menard and True Value are significantly lower than Home Depot and Lowe's, with the Menard Group coming in at $7.6 billion in revenue and True Value coming in at $1.86 billion. Is our stock priced fairly? The closing prices for both Home Depot and Lowe's at the end of 2012 show that both stocks are extremely undervalued at $61.85 and $35.32 respectively. The analysis shows that Home Depot had a calculated value of $78.40, where Lowe's had a calculated value at $48.86. Therefore, both stocks being extremely undervalued.